Dear viewers, this is our Expert Speaks program of Tuesday. This week, I have brought an expert to this program who will answer the tax implications on the property transaction that you might be doing in India as an NRI. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, the expert of the week is Chartered Accountant Mr. S.S. Nayak, who is going to answer your queries on the tax implications of property transaction. Mr. S.S. Nayak has appeared several times on our channel before. He is a practicing chartered accountant with more than 3 decades of experience, a man who has helped the general public, the entrepreneurs, students in various aspects of the financial transactions. He runs a popular television show called The Business Tonic, which is sponsored by Karnataka Bank Limited. The Business Tonic program has run close to 200 odd episodes till date. Mr. S.S. Nayak is also the chief mentor of Atal Incubation Center at NITE, which is started by Niti Aayog of India. He has been awarded with several awards including Lifetime Awards. He has appeared on several television shows and the All India radio programs as well. Welcome to the show, Mr. S.S. Nayak.
Thank you, Dr. Bhatt.
Right. Mr. Nayak, my audience has asked me a lot of questions in the comment section pertaining to the tax implications of property transactions that they might be doing in India. I have collated a lot of these questions of many people, and I am asking you few of these questions. I want you to help the audience with your expert answers.
Sure.
Right. My first question to you is, when somebody sells the properties in India, how will they get taxed? What sections and what type of taxation they will go through?
Normally, income tax is applicable on the basis of period of holding. If the property is held more than 24 months, then it is a long-term capital gain. If it is up to 24 months, it is short-term capital gain. In case of long-term capital gain, concessional tax rate is applicable. 20% tax rate and surcharge whatever applicable, and in case of short-term capital gain, it is 30% is the tax rate applicable, and applicable surcharge and education cess. Surcharge presently is 50 lakhs to 1 crore. If the income or the gain exceeds 50 lakhs up to 1 crore, it is 10%. If it exceeds 1 crore up to 2 crore, it is 15%. If it exceeds 2 crores up to 5 crores, 25%. If it exceeds 5 crores, it is 37%.
Surcharge on the capital
surcharge
gain.
on the tax.
Right.
Tax plus surcharge together amount, on that again 4% education cess.
Right.
That is applicable for property transactions.
Right. Okay. Mr. Nayak, audience is asking, yes, they are prepared to pay the taxes, but for NRIs or for any person who is selling the property, while they have to pay these capital gains taxes, long-term capital gains or short-term capital gains tax, are there any provisions where the government has given them a benefit that, okay, you do this, I will exempt you from the capital gains tax? Any benefits are given by government to reduce this tax impact?
There are 3 avenues by which one can save taxes on sale of capital asset long term. One is section 54, another is section 54F, another is section 54EC. As per section 54, if you sell house property, whatever capital gain you are getting, capital gain means net sale consideration minus indexed cost of acquisition and improvement. Indexation in 2001 it was 100, now it is 331. Suppose if you buy a property in 2001 for 10 lakhs, now the value is 33 lakh 10,000.
After indexation?
Yes, after indexation. In excess of that. So it is considered as capital gain. that gain should be invested in purchase of another house property within a period of 2 years or before 1 year of the sale of the property. Or if you want to construct within 3 years, you can construct the house property. In such case, to the extent of investment, your capital gain is exempted.
Right.
One more clause is there. If you can't invest in the new house or buy the new house before the due date of the filing of the return, then you can park the fund in capital gain deposit scheme. In capital gain deposit scheme, you can park in any of the nationalized banks.
Right.
From there, as and when you are purchasing the property or as and when you are constructing the property, you can withdraw and invest in the property as per the time frame.
So, wherever the time limit is involved, you have to park that entire considerations in that particular capital gains account.
Provided if you are not investing before the due date of the filing of the return.
Right. So, that's what I am telling you. So, you have a 3 years time to construct the
Correct.
house. But you can't use that money.
Correct.
But you have to park that money in that capital gains account.
From
and
there you
show
can
to the
utilize.
tax authority that you have an intention to buy it.
Correct.
And you can make a claim. And
Correct.
that can be used only for construction. And you can claim the exemptions under
Correct.
that. What if it is a commercial property? You said about the house property. What about the commercial property?
Other than house property, maybe land, maybe commercial property or industrial property, other than residential house, if you sell, net consideration, not capital gain, is to be invested in another house property as per this
Like
rule.
it, you are replacing this. You are
Correct.
selling one property.
Correct.
And in lieu of that, you are buying another property.
Another
The
property.
entire chunk of money has to move there.
Correct.
Net consideration after deducting your cost.
Correct.
Then they are eligible for the capital gains
Correct.
tax. Right.
Because the intent of law is very clear. House, if anybody sells, means there is more leverage is given. Other than house, if any other properties are sold, they are taking very strict rules for payment of taxes.
Right.
Next, section 54 EC. Section 54 EC, if you invest in capital gain bonds within a period of 6 months from the date of sale, up to maximum of 50 lakhs only it is permitted.
Upper limit.
Yes. And this capital gain bonds presently they carry only 5.5% interest and it is lock-in period 5 years. Up to 5 years it is lock-in. Soon after 5 years you can withdraw that money and you can utilize the money as you wish.
Right.
That advantage is also there. So these are the 3 ways how tax planning can be done in case of long-term capital gains.
So when they invest in the bonds, what happens to the interest, the 5.5% they get? Is it exempted from income tax or that has to be computed into your income tax calculation?
No. Interest is taxable.
Interest is taxable.
Yes.
Right.
That particular year, whatever other income is there, along with that, interest is taxable under the head income from other sources.
Right.
It is not exempted.
Right. Mr. Nayak, property transactions involve obligations towards TDS. Is there specific guidelines or there is specific provisions with respect to TDS for property transactions done by NRI? Can you throw some light on that? There are a lot of questions that have come with respect to TDS. Who has to do? How much has to be done? Please give some answers on that.
If NRI is a seller, buyer has to deduct tax at source while paying the consideration amount. If it is long term, 20% TDS is applicable plus whatever applicable surcharge and cess. If it is short term capital asset sold by NRI, then it is 30% and applicable surcharge and cess TDS is to be done by the buyer.
That's huge. So a buyer has to make sure that the seller is whether he is a resident Indian or if he is an NRI. If he is an NRI, then the obligations of TDS is pretty huge in this particular case.
Correct.
So it's a very, very important step.
Huge because see, once property is sold, government has no control over seller. They cannot later on, suppose after sale, if they don't file the return, if they don't pay the taxes, government has no control. That is the reason it is deducted at source. But there is one avenue. NRIs, they can apply in form number 13 to deduct tax at lower rate or nil rate based on the actual calculation. If they do that, then if there is no liability, then it will be nil. If there is liability, whatever lower rate also can be done, provided the department is giving the certificate in form 13A. If the seller, being a NRI, produces this certificate, then buyer need not have to pay TDS if it is nil rate, or has to make TDS at lower rate if it is in the certificates mentioned at lower rate.
Now this form 13 and 13A what you talked about, who has to give this certificate? The chartered accountant has to give this certificate, or the Department of Income Tax has to give this certificate? What is the procedure to follow in this case?
Form 13 is applied by NRI only. They can take the assistance of chartered accountant. In that all the details is to be mentioned. Earlier tax returns or estimated tax, whatever applicable, and other details, agreement for sale, all these details is to be given along with the computation and whatever applicable tax or estimated computation. That is to be applied online, and there is a separate department called International Taxation Division for NRIs. They process this application. Normally it takes little bit time, 45 to 60 days time it will take. So if they want at lower rate of tax, they have to decide well in advance, so that there will not be any problem of that higher rate of TDS.
So if 20% or 30%, depending on whether it's a long term or short term gains tax, if it becomes too much for you to do this, alternative is apply to department using this form 13, get a prior consent about the exact amount of taxes that you have to pay, or whether it is completely comes under the nil tax thing. So it can also result in a capital loss.
Correct.
So they need not pay any TDS. That could be the best method for NRIs when it comes to question of solving this problem of higher TDS.
Correct.
But it can't be done in a hurry. You have to give the
It will
time.
take 45 days to 60 days.
Yes. So it takes time, but it is worth it than going through that hassle of paying 20-30%
But
TDS.
you will get refund when you file the return. You will get refund along with interest.
Right. So
That
one
fair
is a
play is there.
preventive move. The second is, even though you have done a TDS, you have to file the tax return and make a claim on that. It is
Correct.
going to be one and the same.
Correct.
But if you are in a hurry, pay the TDS.
Correct.
If you are not in a hurry, apply for it and get the exemptions and then move forward.
Right.
Okay. Mr. Nayak, the property transactions will involve registration and the stamp duty. Who has to pay for the stamp duty? The buyer or the seller, or there can be an arrangement? What is the position of law here?
Normally, buyer has to bear registration and stamp duty.
Okay.
But in case it is agreed between the buyer and seller otherwise, as whatever agreed, it should be done.
Right. Okay.
It may be 50-50 between both, or it may be borne by the seller as agreed. But normally it is borne by the buyer.
Practice is buyer.
Buyer.
But you can have your own arrangement
Correct.
itself. Right. Okay. Mr. Nayak, there are some very specific cases which people have pointed out. I don't want to sell the property. Rather, I want to exchange this property for another property. In that case, how does the system work? Whether stamp duty has to be paid, or it's just a consideration between two of them, and what happens to capital gains and the income tax when the consideration is paid by an exchange of another property, the stamp duty angle and the income tax angle.
Normally, whenever there is exchange of property, stamp duty to state government is to be paid on the bigger property. Stamp duty applicable on bigger property is to be paid. Both the property you need not have to pay. One advantage. But if the exchange takes place, if the bigger property and smaller property, then bigger property, whatever that SR value or agreed value, on that stamp duty is to be paid. One thing. Second is regarding taxation. Whenever any property is exchanged for another property, the value at which is agreed, that is to be taken as a sale consideration, and based on that whatever applicable taxes is to be paid by both the parties.
Okay. So the valuation you put it in the document there, that is treated as your sale price. You compute your capital gains based on that,
Correct.
and you pay the applicable taxes, short
Correct.
term, long term, whatever is the
Correct.
applicable thing. So
Correct.
even in case of an exchange, even though there is no money which gets transacted in this case, applicable stamp duty and applicable income tax will follow.
Correct.
Okay. Mr. Nayak, some of the audience have asked me a very pertinent question. It's a pretty tricky question. I'll ask you this question. When the property sale happens, while registering the property, there is a guidance value with the registrar. But in practical situations, many a times the dealing is happening for value which is lesser than the guidance value. Let me explain how it happens. There is some problem with the property because of which it will not sell at the guidance value. The seller is in a distress and he wants to get rid of this as early as possible, and he will not find a buyer to buy it at the guidance value. Then what happens to the stamp duty? It's a genuine case. It is not something somebody is trying to voluntarily do something to avoid the law. It is a genuine case. How does the law treat such cases? What implication it will have on stamp duty, income tax? Can you throw some light on that?
See, as per the state government guidelines, they have one guidance value for the property. Property should be registered at least for that guidance value or more of the whatever agreed value.
Right.
If the agreed value is lesser than the guidance value, the sub-registrar will register, but he will not give the document. He will refer that to the district registrar.
Okay.
District registrar, he will issue the notice for undervaluation, and we have to reply the reasons, and he will make a spot inspection. If the reasons are genuine, he has the authority to reduce the SR value as he likes. But whatever value it is registered and stamp duty value or whatever agreed value by the district registrar, on that stamp duty is to be paid to the state government. That registration part is over.
Okay.
Now taxation implications,
Okay.
that is very rigorous. Under section 50C of the Income Tax Act, if any property is registered under valuation, then lesser than this SR value, sub-register valuation or guidance value, then the difference between guidance value and actual value registered is deemed to be capital gain for the seller and deemed gift for the buyer. It's very dangerous. But here one cap is there, 10% deviation is permitted
Okay.
than the guidance value. If it is, the difference is more than 10%, then the difference between actual value you are registered and guidance rate, it is deemed capital gain for the seller. He has to pay capital gain tax on that, deemed. And for the buyer, it is a deemed gift. He has to pay 30% tax or whatever tax applicable. It will be income for him.
He is not entitled to get a gift if he is not a
Correct.
relative.
Correct.
And because of which he has to pay a gift tax on
Correct. For relatives, of course, that gift tax will not be there.
that. Right.
But this section 50C, people have to properly follow. Otherwise, they are unnecessarily in trouble. Because nowadays, as per specified financial transactions reporting, all these property transactions, 30 lakhs and above, it will be reported to the income tax department automatically by the sub-registrar's office.
So you mean to say in that case, if the district registrar has approved that okay, this can be registered for a lesser value, then the stamp duty has to be matching with the registration value.
Correct.
Then there will not be a problem.
No.
But if you pay a higher stamp duty based on the guidance value,
Correct.
and the documents get registered for a lesser value, it affects both the buyer and the seller negatively.
Negatively. But one exception is there. As I already mentioned in my earlier episode, auction sale of the property by banks. In case of auction sale of the properties, whatever auction price, that will be taken. Here the undervaluation rules will not apply.
Okay. So if it is an auction, undervaluation rules will not apply. But if it is an exchange of properties between two individuals for a consideration which is less than the guidance value, and if it is not approved by the district registrar, then you are unnecessarily inviting trouble,
Correct.
right?
Correct.
Mr. Nayak, last question to you in this video. A lot of audience has asked this question and they want a favorable answer from your side. They are telling, I would like to pay the considerations using cash for reasons whatever that is known to them.
Normally seller may not be. Buyer may insist for payment in cash.
Whatever it is, but they are telling that I will pay you in cash. How much cash can be received by the seller when a transaction in property happens? What does the rule say? What is the risk and what is the opportunity?
Actually, cash transactions are prohibited. Any property transactions in excess of 20,000 and more, it is prohibited.
It is prohibited.
Prohibited. And if you do the transactions in cash, it should be either by check, it may be by DD, or it may be RTGS or electronic transfer.
Banking
other than
channels.
this mode, banking channel, if you do other than this by this mode, if you make cash transactions, the person who sells and receives consideration in cash under section 271D of the Income Tax Act, 100% penalty is to be paid by the person who receives cash.
A receiver has to pay 100% penalty. So, dear viewers, if you have an intention to receive considerations in the form of cash, please resist that urge, and the law does not permit. The maximum limit is 20,000. So, every consideration has to go through the banking channels, and that's the only option in front of you. Cash is completely ruled out.
Correct, you are right.
Right? Okay. Mr. Nayak, thank you very much for your time and kindness to come all the way to our studios. Spend your precious time answering the queries of my audience. We remain in gratitude to you for your kindness. We keep calling you again and again, and please be kind enough to come again and again to my studios to answer the questions of my audience. Thank you very much for your kindness.
Thank you, Dr. Bhatt. It is my pleasure to participate in your NRI Money Clinic always, because your money clinic gives a proper medicine by a financial doctor, by Dr. Chandrakant Bhatt.
Dear viewers, hope the video that we have done today helped you to get answers to various questions that you have put in the comment section with respect to property transaction. If it did help you to get the right answers, please like this video. If you are a person who is watching my channel for the first time, or if you are yet to subscribe for the channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you next Tuesday with one another expert with one another topic.
Press the bell icon for more details and subscribe our channel.